Don't let your preferred mortgage get equitably subordinated. Equitable subordination originated as a doctrine in the bankruptcy court that allows for subordination of claim when the claimant has engaged in some type of inequitable conduct which has conferred an unfair advantage on the claimant or resulted in injury to creditors. The good news is that getting your preferred ship mortgage equitably subordinated is rare and preventable. The bad news is that getting subordinated can be quite expensive. Adopted relatively infrequently by admiralty court, equitable subordination is a favored play of outranked maritime lien creditors with few options, sort of a Hail Mary pass. However, a heartbroken football fans are well aware sometimes those passes hit pay dirt. How can such subordination be prevented? Let us count the ways. Exercise due diligence to discover potential fraudulent activities of your borrower. We will assume that Marine Money's diligent readers are not. Adopted relatively infrequently by Admiralty Court, equitable subordination is a favored play of outranked maritime lien creditors with few options, sort of a Hail Mary pass inclined to commit fraud themselves. However, what if a lender's substandard lending practices unintentionally allowed a borrower to defraud others, including the bank itself? A Southern District of Florida decision indicates that the bank's mortgage can be subordinated. The borrower created two different whole identification numbers to enable him to use the same vessel both as collateral for a bank loan and to sell the vessel to an innocent third party for cash. The bank had knowledge from a survey that the original HIN was not permanently affixed to the vessel at construction as required by Coast Guard regulation. Further, despite the borrower's financial freefall, the bank extended its loan to borrower without implying the collateral, requiring proof of insurance or investigating whether the vessel remained under the borrower's control. The court found that the bank's gross deviation from acceptable banking practices in 2008 and its failure to insist that borrower permanently affix the HIN on the vessel before initial documentation in 2003 justify the subordination of the bank's mortgage in this case. Don't use the debtor as creditor's alter ego or instrumentally. While making a loan to a subsidiary is not uncommon in the maritime world and is not by itself fraudulent, it does come with some added risk. The Fifth Circuit's seminal decision in Custom Fuel versus Lumbus illustrates how such a loan should not be done. The bank foreclosed on a vessel that was owned by a company controlled by Lumbus. The bank then formed a wholly owned subsidiary and capitalized the subsidiary with $1,000 and extended it a $2,000 line of credit. The bank then sold the vessel to the subsidiary, which borrowed the full amount of the purchase price and took a first mortgage on the vessel. The bank subsidiary then bareboat chartered the vessel back to another Lumbus-controlled company. The Fifth Circuit described the bank subsidiary as not a true debtor but an instrument of the controlling credit used to shield its property from the claim of other legitimate creditors. The court concluded that the mortgage was a sham and must be subordinated to the claim of legitimate creditors, a fuel supplier and repair yard that had maritime lien claim against the vessel. Conversely, a mortgagee with a legitimate mortgage can use equitable subordination to subordinate superior maritime lien claim. In Florida Bahamas Line Ltd. versus Steel Barge, a foreign ship mortgage holder was able to subordinate a superior maritime lien claim for wharfage by demonstrating that the vessel owner and the wharf owner and its assignee were alter egos of the principal, Joe Brown. Mr. Brown and his alter egos has engaged in inequitably conduct by failing to notify the mortgagee of such wharfage lien and failing to attempt to enforce such lien for 46 months. Ensure that your borrower isn't undercapitalized. Undercapitalization, like the instrumentality theory discussed above, requires the court to look to the true nature of the transaction. In undercapitalized companies, a purported debt is often, in substance, an equity interest in the debtor. Undercapitalization is also a hallmark of another bankruptcy doctrine, recharacterization, which is used to recharacterize debt as a capital contribution. In custom full, the subsidiary, having borrowed the entire purchase price, began with no equity in the vessel. The note owed to by the subsidiary to its parent had no fixed payment schedule, and the subsidiary didn't make regular payment on the note. The fact that while making the loan to subsidiary is not uncommon in the maritime world, and it is not by itself fraudulent, it does come with some added risk. Amount owed on the note after 3 years was greater than the amount owed at the date the note was signed, indicate that it was not intended to be repaid in the ordinary course, but instead was meant to become a permanent part of the entity's financial structure. Court often describe two different types of undercapitalization. First, insufficient initial capitalization to make a viable business, and second, inadequate capitalization to obtain an advance from an informed outside lender. While custom full involved the former, the maritime lien claimant in the Pride of Texas relied on the latter type of undercapitalization. They argued that Marriott, the mortgagee, propped up the vessel-owning debtor to the detriment of maritime lien creditors when no other lender would have made advances to the debtor. Such arguments have generally not fared well because the mortgagee's priority over the maritime lien claimant typically remain unchanged despite allegation the mortgagee should have foreclosed earlier. Generally, for a first mortgagee to lose on equitable subordination, the maritime lien claimant must show how they were harmed by the inequitable conduct. No such harm was present in the Pride of Texas. Such harm was apparent in custom fuel because the lien claimant would have had priority over the bank if the bank had chartered the vessel directly to the operator instead of first going through the convoluted sale of the vessel to a wholly owned undercapitalized subsidiary and the taking of a ship mortgage. Don't take a gratuitous security interest. Marine finance attorneys should be careful to show what consideration is being given for a lender's security interest or a modification thereof. Thank you.